Well, hey, everyone. This is Warren Howe. Today, we're going to talk about strategies. Yep, one of the strategies that I personally use with a combination of fundamental analysis and technical analysis. Yep. So, I've been saying this, and I've been saying this a lot of times, and I'll be saying it again. This is one of the easiest strategies that we can use to combine stock charts, stock price, and the fundamentals of the business. Now, let's talk about Square. Yep. This is essentially one easy way that we can actually, it's easy to say, but obviously it takes time to develop. Yeah. Because number one, we got to be building up a thorough fundamental analysis. Yep, on this particular company. Let's say you identify a company like Square, you like its fundamentals, you've worked out the buy plans, your sell plans, you've worked out your, qualitative analysis with a combination of quantitative analysis, and, in 5 years' time, you decide that you want to hold. Yeah, you want to be holding on to Square and maybe even scaling your entries as you go. So that's step number one, which actually takes time, right? Especially if this company is not within your competence. Competence meaning that this is not within your field, your industry, something that you really don't understand. But what we preach is that we should always be expanding that circle of competence, right? Being the modern Warren Buffett. Being more familiar with different set of industries, or you could just be sticking to the industries that you could understand and you can make money out of that sector, right? That happens. So that's number one, where this will take time, but it is a thorough analysis of the fundamentals. Number two is that when we see, if we are in the market long enough, if we are seeing the stock price move, right, and we know that this stock is a volatile stock, it's a high beta stock, that means it's volatile in comparison with the S&P 500 movements, what is happening? Yep, we can see several supports, right? We can see several supports here, and there's a huge support. Yep, let's say we were trading in the month of May, yep, or even the month of March. Now, every year, the S&P 500 and stocks, right, they go down, they go up, they go down, they go up. There are definitely huge swings in movements, and it could be anything. It could be the Israeli war. It could be suddenly inflation hits again. It could be interest rates, right? So there are definitely catalysts, but there are also definitely headwinds from the macroeconomics perspective that might influence all the stocks. Now, my point is that if we are in the market long enough and we've been following up on the company long enough, just to be eyeing and catching on dips, we could potentially make huge swing trades. Okay, so what do I mean by this? After we identify number one, we build a position, right? So let's say you buy at 190 or 200. Yep, let's say you buy at 200, and it's all good, right? It goes up 274. We make an easy 30%. Now, let me check. Is this 30%? Yes, it is. We make an easy 36%. My question is that should we sell, right? When you develop a long-term hold on this company, should you sell on a 36% return? So let's say you didn't sell. Yep. And it goes back all the way to 200 again. Now, for people who do not understand the stock market and they're not really strong in their mindset, they'll be saying, okay, you know what, this stock is probably going to go down again and I'm going to sell at 200, right, at my cost, because I do not want to lose money. See, that's what differentiates us, long-term investors and fundamental investors, knowing that. Yeah, because we know we're holding a solid business. Solid businesses do well in good times, do bad in bad times. It's about how they survive during the bad times. And, what is the valuations and what are your buy or sell plans in the future? Yep, in the future, right? 5 years from now. So my point is that if it reaches to 200 again, what would you do? Okay. But number two, how we profit off this is that it potentially created another support level that we can actually buy. Yep, and this is exactly what we did on March, on May. As long as your portfolio management allows it, your portfolio sizing on this particular stock allows it, then we could be potentially adding on another tranche. Now that tranche could be on a shorter term gain, or you could be averaging down your costs or be adding more positions in the same cost that you have. Does that make sense? So basically what I mean is you could choose, right? Because they established a support, and when the price ran up, they establish a resistance. Now, during this resistance, you could be taking off that tranche profit. So let's say you added in 10,000 USD worth of the first tranche and second tranche another 10,000. You could consider to be taking off profit out of your 10,000 on the second tranche. Yep. Or just leave your capital, take out your capital and leave all the profits there to run. Because 10,000, how many percent is this? 36% is 3,006. So you could let that 3,006 run because it's, practically free money. Right? Then now the stock price drops down again to 200 and even lower, probably even 190. Now, if you do not have that fundamental, analysis as a cushion, that's a problem because you'll probably sell again. But those who understand, right? Yeah, that we are holding a good business and we know the strategy of fundamental analysis and a little bit of technical, it's as simple as reading support and resistance, right? So this could be a strategy that we could use. And we could probably even profit off again from the resistance, because right now it's testing resistance, but you could be adding, all you got to do is allocate capital, right? The stock price could be going up again, or if it doesn't, you got a cushion. You see how beautiful this is? So I hope you got some value out of this. These are actually strategies that I personally use, right? We follow up on the stock enough, we study the fundamentals, we look at the stock price, we look at the stock price, stock charts, because we want to be flexible and we are in the market. Right? It's most importantly, we are always in the market, so we can capture on good dips, right? And you could probably even sell off a tranche, right? And be allocating capital, letting profits run free. Okay? So I hope you got some value out of this. I'll see you in the next one. Thank you.